Hello, we're working on bond valuation, and I wanted to go over an example of a bond example here. So we have a bond with $1,000 par value and is issued at year 0, matures at year 5, and has a 10% coupon, and we're going to calculate the price of the bond. So how do we do this? And I encourage you to play with this Excel file. I will provide it to you. How do we do this? We basically look at the cash flow, so it's $100 a year because that's 10%. And then we have a discount factor, and the discount is always going to be 1 plus the risk rate. So an issued bond at 10%, meaning that is actually its true risk rate, right? But that can change. So what happens is we use the discount factor and we square it, cube it, and so forth later down the line to come up with the present value of each value, and then we sum it up to get the value of the bond. Right. So now, what's interesting is that in practice, what we can say is like, okay, say this was a governmental bond that came out a year ago. All of a sudden, the rates really went up, and now the rate on this bond is really 13%. That's the risk rate. This is where the trading value of that bond would be. So we can start figuring out, hey, what happens to the rates? How's that going to affect the bond price? So that's really the idea behind the bond valuation. And when we model this out, we have to know what the cash flow is, and that is with bonds what's nice, that's very much fixed. The discount rate is what changes, not the cash flow, and the discount rate changes later. It always equals the coupon at the beginning. That can be somewhat confusing. That's why it equals out, right? But later down the line, it very much changes. And, for example, you could have a country, I think Venezuela now, where they have like a 40% yield. So what happens is with such a big discount rate, the cash flow still remains the same, but you could see the bond value is very cheap. So you might want to buy that at $3.89 now, and then hope, hey, they're going to come back maybe to a 25% yield, and you're going to go from $3.90 to $5.90. That's a 50% return. So it's just something to think about with bonds. A lot of times we focus on the coupon, which is actually for modeling, it's very nice because it stays the same. And then the yield is something that comes to us. That's what the market tells us what the yield is. And I think that's the interesting part for bond valuation, because the market tells us, the market actually communicates the yield to us via the price. So if we have a company that they're about to default, it will be trading very, very low. And now actually the yields are very, very low. So you might have bonds that are actually very expensive. Right now people are saying, hey, these bonds are very expensive, or the treasury bonds are very expensive. That's because the yield is very low. The lower the yield, the higher the price.